Welcome back to this video series on equity investment for the CFA at level one. My name is Revi Panida. I'm a private tutor based in London. So today I want to discuss three areas. I want to discuss compound interest. I want to discuss retained earnings versus payout, meaning when does it make sense for a firm to retain earnings versus pay it out? And then I want to come back to an evaluation model, which is perpetuity with growth, but I want to revisit in the light of what we're about to discuss. Now, when I teach finance to students, I love training them about how to think about compound interest, which has been labeled as the eighth wonder of the world. Um, if you invest £10,000, let's say in a bank account or in some business that gives you 20% returns for 50 years, and you pause there for a second, right? And you go to sleep, and then 50 years later, maybe you're in your early 20s and now you're in your early 70s, and you go to check that bank account, the question is how much money would you have, right? And if you think about this problem very linearly, okay, 20% of 10,000 is £2,000. If you get £2,000 over 50 years, that's an extra £100,000, and maybe you're going to make some interest on interest. And maybe a reasonable answer, what might seem as a reasonable answer, is to say something like 150,000, right? 150,000 pounds. And I'm giving you these numbers because fairly frequently students do give me numbers that are similar to this. And it turns out that really the right way to think about this problem is the follows. The right way to think about this problem is to say, well, if it's 20%, that means that you're doubling every 3.5 years approximately. Okay. So if you have 50 years, then well, in 50 years, you're going to do quite a bit of doublings, right? So you're going to do 10 doublings in 35 years, okay? So there's quite a bit of doubling happening there. And 10 doublings, right? 10 doublings is 2 to the power of 10. 2 to the power of 10 is approximately 1,000. So 1,000 times 10,000 is 10 million. Okay. So you already get a sense that just a quick change there in your mindset about this idea of, you know, doublings happening at constant intervals, right, would get you a very different answer. So you're already at 10 million, and you know that you got more doublings to do. And if you're a bit more careful about it, you might come up to the right answer, which is 81 million. Now that's a staggering amount of money. The reason for that is that we are quite good at thinking in linear terms. So think of this as time, right? And you start here with some amount, 10,000, okay? And initially, a line sort of like approximating this growth, right? It's not terrible, okay? But over time, that line becomes really terrible because that's an exponential growth. Okay, so the power of compounding is very powerful, is very misunderstood. Even by relatively highly trained individuals, they're not going to get this. They're not going to get this quite right. Now, why do I give you this compound interest? You're going to have some CFA exams, exam question that might ask you about compound interest, but you can have a calculator. So you really don't need to you don't need to do them in your head. But I want you to think about this explosive exponential nature of compound interest because I want to talk about something else now. Imagine that there is a business today that in year zero, they start their life with $100 as their equity. Okay. And let's make certain assumption. Let's assume that this business is going to have a return on equity of 10%, meaning that this is their equity in year zero, but they're going to have a return on equity of 10%, which means that in year one, they're going to have a net income of $10, which is 10% of that $100. Okay. Now they're going to have a crossroad here. What's going to be the equity in year one? Well, it will very much depend on what do I do with that $10. I could retain it fully and therefore I'm going to have $110, which means if I retain it fully, the dividends that I'm paying are zero. That's one view of the world. Or in a different view of the world, I could um, I could have um, I could have situation where I distribute all of this. So the net income is $10, but I distribute all the $10. So my dividend payout is $10, and therefore my equity remains $100. Okay. And the question now is, okay, I've got this business that the return on equity is measuring how successful this business is. These businesses. Okay. And what will happen in year one, in year two? Well, if you take the first approach, well, you're going to have a higher equity, and now your net income is going to grow by 10% of your equity. So you're going to have $11. In the second part of the world, your equity is $100. So you're still going to have an equity of 10%, right? Of $10. Now, imagine for a second, I want you to just imagine for a second, how should we evaluate this business, right? What should be the valuation that we should have on this business under the two methods? Okay. Well, to do that valuation, we need to ask ourselves, what is the opportunity cost of capital? What are we going to use as a discount rate? And in this case, I'm going to take a 5%. Okay. Now, if you think about this business for a second, the equity that it required was 100. Now, if they're paying out, so this is case one, this is 100% payout. If they do 100% payout, well, that's an easy one because this is going to boil down to perpetuity. They're a successful business. They can return money at 10% of whatever money they hold of their equity, right? And in year zero, you say, I'm going to get 10 forever. What's my perpetuity formula? 10 divided by 5% is equal to 200. Okay. Look, the market is taking an equity. It cost you $100 to build this company, but maybe because you have this good idea of growing this $100 at 10%, the market says, wow, I'm going to reward you. I'm going to double the value of that equity, right? It cost you $100 to build, but now the market's going to value that at twice as much, right? At 200, if that is 5%. Okay. Now, imagine the second case, in our case two. Imagine for a second that we're going to have zero payouts for, let's say, 10 years, or 0% payout for 10 years. And then we're going to make 100% payouts moving forward. And let's again assume that the interest rate stays at 5%. Now, take a moment and pause the video if you like, and see if you can tell me what you think the valuation of that company will be, right? Will it be more than this 200, less than this 200, or the same 200? And try to think intuitively why that the decision that the company is making that might make a difference in that payout. Um, so if you think about this, what will happen here is that in year zero, we're trying to evaluate the price, but in year one, we get zero. And in year two, we get zero. We have to wait all the way to year 10 to get something. Okay. And actually in year 10, you also get zero. Okay. In year 11, it's the first time you're going to get some payment, some coupon, and you're going to get that forever. And that coupon is going to be fixed. So our job is actually to figure out what that coupon is, and then figure out the perpetuity, and then discount it by those 11 years. So it's actually not very, very difficult if we realize that we're going to work with $100 in equity. This $100 in equity, okay, in a year's time is going to grow by 10%. So by the end of the 10th year here is going to be 1.1 to the power 10. I will bring out my calculator. then we will have 100 times 1.1 to the power of 10. That's $259 approximately, which means in year 11, I'm going to pay $25.90. And that's going to be a perpetuity. Okay. It could be, right? Another way to kind of think about, another way to think about this is that the business is going to retain the earnings for this period, right? And then maybe perhaps at some later stage, will start to reward their shareholders, right? And we're maintaining the assumption that they could still get a return on equity at 10%, which might also be an assumption to challenge and see more carefully sort of down the line, right? But how do I value that? Well, the price today is going to be a 25.9 perpetuity divided by 0.5, but I'm going to get this in 11 years. Okay. So that perpetuity, right? The value of this perpetuity will be valued from year 10's perspective. Remember, we have to have 1 year wait for the perpetuity formula to be held. So it is as if this payment is captured in year 10. So therefore, I discount this by 1.1 to the power 10. So I bring out my calculator. So a 5% capitalization rate, which is exactly what I'm doing, this is the same thing as multiplying this by 20. So that's kind of nice mental exercise that you could do. So 525 times 20 is 518. So 518, we're discounting that to the power of 10. So let me just do that. 1.1 to the power of 10. And that is 199.71. Okay. So note that figure, right? That figure. Oh, I made a mistake here. Can you see my mistake? I made a mistake. We are discounting not at 10%. We are discounting at 5%. So this is 0.5 and this is 0.5. But that's actually a good mistake, an interesting mistake, because if we are discounting at the 10%, which is the same thing as the return on equity, right? This highlights that the payout time, right? The payout structure is completely irrelevant. Okay, so if when the return on equity is the same as your required rate of return, okay, or as your opportunity cost of capital, it doesn't really matter when the business is doing the payouts, okay? And you get the same value. But in this particular case, we're assuming that the business is compounding at a higher rate than your opportunity cost of capital. So now we're actually going to fix this and say 518 divided by 1.05 to the power of 10. And of course, now this answer is much larger. It's 318. So here we have it. We've got two cases where you do a full payout, you get a $200 valuation. You don't pay out this money and you build up more equity at 10%, and then you start paying out, you get a 318 valuation. Okay. So going back to what we wanted to discuss is this idea of when should a business retain earnings versus paying them out? Well, the answer has to do with how successful the business is. If you've got a business like Berkshire Hathaway, where the return on equity has at least historically been much higher than most people opportunity cost of capital, or the required rate of return, the R, you want such businesses to keep retaining their earnings. Okay? You want such businesses to keep retaining their earnings. If I flip this exercise and I gave you an exercise where the return on equity was lower than the opportunity cost of capital. You want those businesses to do the opposite. You want them to pay out as much as possible. In fact, you might want those businesses to fully liquidate and not be in operation, right? Because they don't return, their return on equity is not much higher. And I would like to conclude with this idea of perpetuity with growth revisited. So if you think about the Gordon growth model, which is you have some dividends coming up in a year from now, okay? And then you do R minus G, you could look out more onto this G as something to do with a return on equity, okay, times the payout ratio. Okay, so if the payout ratio is um, uh, sorry, one minus the payout ratio, right? So if the payout ratio is 100%, then your growth is zero because you do not build up equity on that. Okay. And effectively, sometimes people say, oh, the Gordon growth model can only be used when companies pay dividends. Well, that's not quite correct, right? Because what we talked about this is that there might be companies that don't pay dividend for as long as their return on equity is larger than the required rate of return, and that would be the right thing for them to do. Okay, so you might want a payout ratio. You might want a payout ratio of zero. Okay, and in the next video we might do some more exercises to kind of illustrate this power of payout ratio versus paying out earnings versus retaining earnings, and how that changes sort of net present value calculations and valuations for companies. I will see you on the next one.